Hi guys! Welcome to the Ancient Monkey YouTube channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about what happens with a country's recession. So make sure to watch the full video. The National Bureau of Economic Research, NBER, defines a recession as a significant decline in activity spread across the economy, lasting more than a few months, visible in industrial production, employment, real income, and wholesale retail trade. A recession is also believed to be signaled when businesses cease to expand, the GDP diminishes for 2 consecutive quarters, and the unemployment rate rises. The nature and causes of recessions are simultaneously evident and uncertain. Recessions are, in essence, a cluster of business failures being realized simultaneously. Firms are forced to reallocate resources, scale back production, limit losses, and usually lay off employees. Those are the clear and visible causes of recessions. There are several different ways to explain what causes a general cluster of business failures, why they are suddenly realized simultaneously, and how they can be avoided. Economists disagree about the answers to these questions, and several different theories have been offered. What is a recession? A recession is a significant, widespread, and prolonged downturn in economic activity. Because recessions often last 6 months or more, one popular rule of thumb is that 2 consecutive quarters of decline in a country's gross domestic product, GDP, constitute a recession. Economists, including those at the National Bureau of Economic Research, NBER, which dates U.S. business cycles, define a recession as an economic contraction starting at the peak of the expansion that preceded it and ending at the low point of the ensuing downturn. Recessions typically produce declines in economic output, consumer demand, and employment. The NBER considers indicators including non-farm payrolls, industrial production, and retail sales, among others, in designating the start and end of U.S. recessions, usually months after the peak and trough of the business cycle. A downturn must be deep, pervasive, and lasting to qualify as a recession by NBER's definition. But these are retrospective judgment calls made by academics, not a mathematical formula designed to flag a recession as soon as one begins. 3. For example, the depth and widespread nature of the economic downturn caused by the COVID-19 pandemic in 2020 led the NBER to designate it a recession despite its relatively brief 2-month length. Recession predictors and indicators. While there is no single surefire recession indicator, an inverted yield curve has anticipated each of the 10 U.S. recessions since 1955, while also setting off a few false alarms. Because longer-term debt has more duration risk, it usually offers higher yields than shorter-term obligations. A 10-year bond tends to yield more than a 2-year note usually, since there is more risk that inflation and or higher interest rates will lower its market value before redemption. The yield curve inverts because the yields on longer-dated debt decline, sending prices higher, as traders anticipate economic weakness and interest rate cuts in the future. Meanwhile, shorter-term rates are more dependent on the federal funds rate and the near-term expectations for monetary policy. If the Federal Reserve is expected to keep raising the federal funds rate, those expectations will tend to lift 2-year yields more so than 10-year ones. Macroeconomic and microeconomic signs of a recession. The standard macroeconomic definition of a recession is 2 consecutive quarters of negative GDP growth. When this occurs, private businesses often scale back production and tries to limit exposure to systematic risk. Measurable levels of spending and investment are likely to drop, and a natural downward pressure on prices may occur as aggregate demand slumps. GDP declines and unemployment rates rise because companies lay off workers to reduce costs. At the microeconomic level, firms experience declining margins during a recession. When revenue, whether from sales or investment, declines, firms look to cut their least efficient activities. For example, a firm might stop producing low-margin products or reduce employee compensation. It might also renegotiate with creditors to obtain temporary interest relief. Unfortunately, declining margins may force businesses to fire less productive employees. General causes of recessions. The significant economic theories of recession focus on financial, psychological, and fundamental economic factors that can lead to the cascade of business failures that constitute a recession. Some theories look at long-term economic trends that lay the groundwork for a recession in the years leading up to it. Some look only at the immediately visible factors that appear at the onset of a recession. Many or all of these various factors may be at play in any given recession. Financial factors can contribute to an economy's fall into a recession during the 2007 to 2008 U.S. financial crisis. The overextension of credit and debt on risky loans and marginal borrowers can lead to an enormous buildup of risk in the financial sector. The expansion of the supply of money and credit in the economy by the Federal Reserve and the banking sector can drive this process to extremes, stimulating risky asset price bubbles. Artificially suppressed interest rates during the boom times leading up to a recession can distort the structure of relationships among businesses and consumers. It happens by making business projects, investments, and consumption decisions that are interest rate sensitive, such as the decision to buy a bigger house or launch a risky long-term business expansion, appear to be much more appealing than they ought to be. The failure of these decisions when rates rise to reflect reality constitutes a major component of the rash of business failures that make up a recession. Psychological factors of a recession. Psychological factors are frequently cited by economists for their contribution to recessions also. The excessive exuberance of investors during the boom years brings the economy to its peak. The reciprocal doom and gloom pessimism that sets in after a market crash at a minimum amplifies the effects of real economic and financial factors as the market swings. Moreover, because all economic actions and decisions are always to some degree forward-looking, the subjective expectations of investors, businesses, and consumers are often involved in the inception and spread of an economic downturn. Economic factors of a recession. Real changes in economic fundamentals, beyond financial accounts and investor psychology, also make critical contributions to a recession. Some economists explain recessions solely due to fundamental economic shocks, such as disruptions in supply chains and the damage they can cause to a wide range of businesses. Shocks that impact vital industries such as energy or transportation can have such widespread effects that they cause many companies across the economy to retrench and cancel investment and hiring plans simultaneously, with ripple effects on workers, consumers, and the stock market. There are economic factors that can also be tied back into financial markets. Market interest rates represent the cost of financial liquidity for businesses and the time preferences of consumers, savers, and investors for present versus future consumption. In addition, a central bank's artificial suppression of interest rates during the boom years before a recession distorts financial markets and business and consumption decisions. All of these factors may cause a recession over time. In turn, the preferences of consumers, savers, and investors place limits on how far such an artificially stimulated boom can proceed. These manifest as economic constraints on continued growth in labor market shortages, supply chain bottlenecks, and spikes in commodity prices, which lead to inflation. When not enough resources can be made available to support all the business investment plans, a rash of business failures may occur due to increased production costs. This situation may be enough to tip the economy into a recession. Impact of COVID-19 pandemic on the economy. In February 2020, the National Bureau of Economic Research, NBER, announced that according to their data, the U.S. was in a recession due to the economic shock of the widespread disruption of global and domestic supply chains and direct damage to businesses across all industries. These events were caused by the COVID-19 epidemic and the public health response. Some of the underlying causes of the two-month recession and economic hardship in 2020 were the overextension of supply chains, razor-thin inventories, and fragile business models. The pandemic-related recession, according to NBER, ended in April 2020, but the financial hardship caused by the pandemic is still impacting Americans. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.